Hello. Let's talk about adjusting entries, the worksheet, and how accountants use them. Before we get started, let's make sure we're all on the same page with some basic accounting concepts. First of all, what is a journal entry? A journal entry is a record of a financial transaction in a company's books. It includes the date of the transaction, the accounts affected, and the debits and credits associated with the transaction. Now, what is an adjusting journal entry? An adjusting journal entry is a journal entry made at the end of an accounting period to bring the accounts up to date. These entries are made to align the reported results and financial position of a business with the requirements of an accounting framework, such as generally accepted accounting principles. So why do we need adjusting journal entries? Well, there are certain types of transactions that cannot be recorded in the accounting records until they are completed. For example, if a company incurs an expense but has not yet received the invoice or paid the bill, the expense cannot be recorded until it is received or paid. Are there different types of adjusting entries? Yes, there are. There are two types of adjusting entries, accruals and deferrals. Let's talk first about accruals. Accruals are any expense you record now but plan to pay for at a later date creates an accrued expense in your books. An example of an accrued expense might include bonuses, salaries, or wages payable. The second category is deferrals. Deferrals are any expense you have already paid, like prepaid expenses. An example might include prepaid rent or prepaid advertising. Let's look at some examples. Imagine a company called Gallagher Enterprises. At the end of the year, they need to make some adjusting entries to properly reflect the company's financial position. One of the adjusting entries they need to make is for prepaid rent. On January 1, 2023, Gallagher Enterprises, a new firm, paid $7,920 rent in advance for a 3-month period. The $7,920 was debited to the prepaid rent account. To record this adjusting entry, Gallagher Enterprises would debit rent expense for $2,640 and credit prepaid rent for $2,640. This will properly reflect the company's expenses for January 2023 by recognizing only the expense that is for January. Here is another example. Gallagher purchased $1,000 in supplies in January 2023. The purchase is recorded as a debit to supplies, a balance sheet account, and credited to cash. Account of all remaining supplies at the end of January shows that $500 in supplies are left. In other words, $500 in supplies were used up and now are considered an expense. What adjusting entry is required? To record this adjusting entry, Gallagher Enterprises would debit supplies expense for $500 and credit supplies for $500. This will properly reflect the company's use of supplies in the current month and the remaining balance that will be used in the following months. Now let's talk about the worksheet and how we use the worksheet in connection with our adjusting entries. A worksheet is a tool used in accounting to help prepare financial statements. It is essentially a spreadsheet with rows and columns that contain all of the necessary information for the financial statements. The worksheet has 5 main sections: the trial balance, adjusting entries, the adjusted trial balance, and then a section for the income statement, and one section for the balance sheet. The first step in preparing the worksheet is the trial balance. The trial balance is a list of all the accounts in the general ledger and their balances as of the end of the accounting period. It is used to make sure that the debits equal the credits in the general ledger. If the debits and credits do not balance, there is likely an error somewhere in the accounting records that needs to be corrected. What is our next step? The next step includes entering the adjustments that need to be recorded. Then, the adjusted trial balance is calculated. The adjusted trial balance includes the adjusting entries made at the end of the accounting period. We need to make sure that all the accounts are properly balanced and up to date before the financial statements are prepared. Finally, we enter the amounts from the adjusted trial balance into the income statement and balance sheet columns. After the accountant completes the worksheet, the adjusting entries are finalized as a general journal and posted to the general ledger. Let's summarize. Adjusting entries are required to properly show the financial results of a company. There are two types of adjusting entries: accruals and deferrals. Accountants use a worksheet to ensure that all trial balance accounts properly balance. Enter the adjustments and then calculate the adjusted trial balance, the income statement, and balance sheet. Only if all accounts balance does the accountant record the adjustments in a general journal and then post them to the general ledger.